Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 348 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including increasing earnings estimates, the new Fed chair's impact on market behavior, the May jobs report, oil supply update, and CME rates. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Aaron, good morning. How are you?
I'm well. I'm doing good.
What's new in your world?
Busy. Just back from some work travels, so it's nice to be back in the office and ready to kick butt on this podcast.
I'm here for this. We also have Taylor coming on for the financial planning topic of the week. Taylor Ledbetter. Got two CFPs on this on the podcast today.
Love it.
You want to start with pricing?
Yes. As always, going to review year-to-date and month-to-date for the major indices across the U.S. and world. So the S&P 500 year-to-date is up 4.24%. Month-to-date is up a strong 9.3%. The Dow is up 1.66% year-to-date and up 5.44% month-to-date. The NASDAQ, or the Qs, is up 6.16% year-to-date and up 14.28% month-to-date.
Strong.
IWM small caps is up 10.73% year-to-date and up 9.71% month-to-date. The Vanguard X United States All World ETF is up 7.73% year-to-date and up 5.37% month-to-date. The 3-month Treasury sits at 3.68. The 2-year sits at 3.89, and the 10-year at 4.39.
All right. So it's interesting to see that strong performance month to date as we get to the very tail end of this month. Interesting, strong reversal month.
A very strong reversal, and we're seeing kind of the higher risk, higher beta areas of the market, obviously performing the most. So not a bad sign, in my opinion.
Yeah, no, not at all. And I think it's a great segue. We're in the midst of earnings season right now. Mm-hmm. So when you think about the bulk of companies reporting first quarter earnings, the concentration is this week of the larger size companies by market capitalization reporting. Yep. And it's always fun and eventful.
It is. It is definitely entertaining.
And also just a nice polite reminder, if you're seeing a little bit of an outsized move in an individual security, there's a good chance it was reporting earnings.
Yep, could be the next day or sometime after the bell is typically what happens.
Correct. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. So let's move on to big headlines and current events, Aaron. A couple things that caught my eye over the last couple of days. First is some housing start data from April 29th. So housing starts increased 10.8% month over month in March to a seasonally adjusted annual rate of 1.5 million units. Building permits, meanwhile, declined 10.8% month over month in March to a seasonally adjusted rate of 1.372 million units. The key takeaway from the report is that there was broad-based strength in starts by region, but also broad-based weakness in permits by region. The latter is a better indicator impact of the Iranian war and the uncertainty it has created because permits are the leading indicator.
Interesting.
And then next, also on April 29th, Aaron, durable goods orders increased 0.8% month over month in March. The consensus by Wall Street was 0.5, so those durable orders surprised to the upside, and that was following an upwardly revised 1.2% decline from a previously reported decline of 1.4% in February. Excluding transportation, orders were up 0.9% month over month. The consensus on Wall Street was a gain of 0.6, so that also beat. And there were some upwardly revised numbers for the previous month of February. The key takeaway from that report is that there's a big jump in new orders, 3.3% non-defense capital goods, excluding aircraft. That's a good proxy for business spending, and it is believed to reflect in part the pickup in capital expenditures for AI.
Makes sense.
Topics.
That's some encouraging data. I mean, those are all good things for the most part in my world.
So I don't have any other comments than that.
Yeah.
So let's move on to tweets, articles, and research for the week. I will lead this off. I saw a post by a charter financial analyst. The name on this individual is Aisha Tariq, and this was a post I saw on XAC on April 23rd. And this post, in regards to earnings estimates, caught my eye. This is what she posted. Analysts are aggressively hiking earnings projections for S&P 500 companies through 2027, with upward revisions significantly outpacing historical norms. All these charts, Aaron, will be in our show notes for our traditional podcast listeners. So if you go to Jessup Wealth Management on LinkedIn or X or Facebook, etc., all of our graphics that you and I discuss, Jenna will put those in there for our show notes. Now, this will be put up for our YouTube viewers. And what you're seeing here is the normal path of how these earnings revisions go. And so for our traditional podcast listeners, I'm going to oversimplify this. What tends to happen is at the beginning of the year, Wall Street has earnings estimates for either companies and or the index in general.
In itself, yep.
And let's take the S&P 500. And what tends to happen is reality hits and these companies might not make these estimates.
So they kind of shoot higher and they come back down to reality.
There it is, right? But what's different right now?
This is kind of the opposite from
It
this
is.
chart, right?
And so we are seeing upward earnings revisions for this year and next, abnormal, and bullish if you're owning equities.
Yeah, absolutely.
Now I'm going to give you one side of this that the bears, individuals who are not bullish on the market, are saying when they see this data point. Yeah, I see S&P 500 earnings going up, but Matt, it's only a small concentration of names. It's still happening. Earnings are going up, and we got to keep in mind that's being pulled up because of the technology sector.
And AI, absolutely.
But at the end of the day, what's the largest sector of the market? Technology. Yep. So you got to face the facts there.
I've got a good piece that's going to go hand in hand with this. So we were like-minded.
I love
doing our research.
For our newer listeners, we never compare notes before we tape, so that's always fun. So the next piece, I found this really interesting.
This is very interesting.
Very interesting. This is a post by the Patient Investor, and the timestamp on this, Aaron, April 25th. And what it is the underlying data source is Fundstrat. That's Tom Lee's firm. The S&P 500 declined by more than 10% on average during the first year of a new Federal Reserve chair. And what's going to happen here over the next month?
We're going to have a new Fed chair.
We're going to have a new Fed chair. So this chart will definitely be in our show notes. Jenna will put this up for our YouTube viewers. And you are now seeing a visual illustration going back many, many Fed chairs. What, about a dozen Fed chairs? Does that sound about right?
And remind me, how long are they appointed for?
I want to say it's 8 years. 8 years, and they can get re-upped. And I'm not 100% confident in that statement, by the way. I believe it's
a
8.
while. It's a while.
And what you're really seeing here is the potential for the market to correct under a change of this leadership, change of maybe Federal Reserve strategy. So I just find it quite interesting data point that a new Fed chair isn't exactly bullish in the history lens of Wall Street. I will also argue that some of the data sets are skewed by several really negative returns that brought down the average.
Yeah, the average is lower than probably the median might be a better indicator, right?
Yeah, that and then the recent Fed chairs, Powell, Yellen, and Bernanke, a little bit better than the average.
A lot better, yeah. Okay.
All right, my third item is the May jobs report that's due out on May 8th. So a little bit of education for our listeners and viewers. Typically, the jobs report for the previous month is released on the first Friday of the new month at 8:30 a.m. EST. However, when that first Friday falls on the 1st, which it does here in May, they typically push it out a week.
Okay.
So the May jobs report is not going to be until May 8th, so a week from tomorrow, Aaron. And again, that gets released at 8:30. Now, what caught my eye on this topic? Yardini Research had a piece, the timestamp on this is April 21st. I'm going to read what Yardini put first, and then we'll talk about the data set.
Sounds good.
Quote, before writing off the labor market, consider this. ADP's 4-week average through April 4th hit 54,000 plus jobs per week, a 2026 high. Could April's official payrolls report catch Wall Street off guard? What is next is a data piece that Yardini attached that shows the ADP National Employment Report preliminary estimate. And what you're visually seeing is from about January up until the first week of March, these job gains were in the
kind of soft.
Yeah, soft, and this 0 to about 15,000 on a weekly basis. And then March hits.
It ramps up.
In
quick.
March 7th, we were at 10,000. March 14th, 15 and change. March 21st week, 26,000. March 28th week, 40,000. April 4th, 54,000. And so I want to throw this out there. This is why you listen to the Independent Advisors podcast. The May jobs report next Friday will most likely beat Wall Street expectations. And you might have a quandary for the market that good economic news is bad for the market, which sounds crazy.
And why is that?
Because the Fed can't lower rates.
Yep. So that's the tightrope the Fed has to walk, right?
Yes.
Is that we've got elevated oil prices, which could lead to inflation, but we've got really strong jobs reports. It's, where do they go?
And I would rather
And
have...
they've just been kicking the can on it pretty much is what's happened.
Exactly right. I'd rather have the strong economic activity and have elevated rates than have rates come down because economic weakness is there, right?
Agreed.
I can deal with both of those environments in the stock market, but I'm liking the strong economic numbers. Now, it's going to be interesting with the new Fed chair, but I just want to throw it out there. We get a strong jobs report next Friday, and the market's negative that day. That could be the most likely outcome, which sounds nuts for a lot of
counterintuitive, but
investors, right?
all right.
And then real quick, before I send it over to you,
Perfect.
I got a bonus piece for our listeners and viewers this week. The future of OPEC and oil supply. So the UAE could now potentially produce more oil than the OPEC quota previously allowed them because they're discussing leaving OPEC. Okay.
Interesting.
And it's interesting to see the domino effects of the Iranian conflict and the redrawing of the lines, let's call it, in the Middle East. In the UAE, they're talking about
Just kind of going on their own.
going on their own and pumping as much oil as they see fit.
Wow.
Pretty-
OPEC would not like that.
Just we'll throw it out there. Quite interesting. Aaron, over to you.
That kind of comes back to the last point, is that could drive oil prices back down. If supply picks way back up, might give the Fed cover to cut rates.
That's
later
right. I
in
mean,
the
because
year.
what's going
But
to
who
happen
knows?
in the room is, hey, these oil prices are pretty high. I better take advantage of this. I'm not sure how long this is going to hang around.
Sure.
So let's pump as much as we can. And then all of a sudden your neighbor is like, well, wait a minute. I want to take advantage of this.
Absolutely.
And what happens to prices when you have excess supply? They tend to go down.
Absolutely. Cool.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
AC?
All right. I got an X post by the CME Group, Chicago Mercantile Exchange, and this is on April 28th. The X post says Fed funds futures curve today versus a week ago versus a month ago. So
Interesting.
Kind of goes hand in hand with what we were talking about with what the Fed may do. Chart is up here. So if you see the current, I'm going to start with the current rates, which is going to be this blue line.
Yep.
That's kind of what, if we look out to, what is that? The second quarter of 27.
That's what it looks like to me.
Yep. They're kind of hovering kind of flat around the same kind of range we are, about 3.5, 3.6% Fed funds rate. And then a month ago, they were at 3.7, that time frame out. They don't really change much, but slightly go up.
Yep.
A week ago, they were forecasted to go down. So there's been kind of a down to 3.45% over the next year and a half or so.
Do you think that's the market just kind of realizing that, wait a minute, underneath the surface, things are not as bad maybe as we were thinking?
I think that's exactly what it is. I think that, having strong jobs reports that might come out, good spending data, I think all of that's kind of giving the Fed cover to just kind of kick the can and hold rates where they're at because the economy doesn't seem to need it that much.
I think, Aaron,
Which is
that's
a good thing.
big part of it, and I agree with that statement. I also have a hot take on this.
I like it. I'm
My
ready.
hot take is stocks have been so strong here in the month of April. Do you have a lot of investors that are like, those bond yields aren't that attractive when I'm seeing what stocks are doing right now? And it's not to say that the performance is going to continue in stocks at this rate or that stocks are even going to be positive the rest of the year. But maybe there's a part of investors that are generally light on the allocation to equities. And if they're choosing between adding more to bonds or adding more to stocks right now, it's probably the latter.
I would agree. All right. Next item here. Got another X post. This is by my guy, Ben Carlson.
Always good
a fan of
content.
him. I'll read what he says, and then I'll show this chart. This is go hand in hand with your earnings estimates. He says, this is on April 28th as well. Why didn't the stock market fall further in the face of a war in the Middle East and an oil price spike?
Preach, Ben.
I know. Why are we already back at new all-time highs? In a word, earnings. I love this. It's perfect.
Right.
So this chart is going to show the S&P 500 large cap, S&P 400, S&P 500, which is mid cap and small caps, respectively. And it just shows, what consensus expected earnings estimates are forecasted to be out. And what's it say right now? The S&P is at 340. The mid caps is at 222. So if you just see this chart, it tells itself is that Wall Street's earnings or stock market earnings are the most important thing.
They
in my
are.
world, right?
In my opinion, it's one of the most
matter what
leading indicators.
No
of
matter what
stock's
happens
performance.
in the Middle East or what oil prices do, if stocks continue to exceed earnings expectations, I think the market can go higher, right?
So far, earnings season, we are having dramatic beats compared to Wall Street estimates
Absolutely.
in like the mid 80% range. And I said this on the podcast last week. I mean, you have an earnings season and you're in the low 70s. That's a good earnings season.
Absolutely.
And we're in the mid 80s of companies beating expectations.
What do we have? 4 out of the Mag 7 report yesterday?
Yeah.
And I think almost all of them beat.
Yeah.
So that's another good sign.
Hey, I just want to... I got to spike the football briefly because, we were talking about earnings estimates in March and the difference between stock prices and underlying fundamentals. So this is something that was being talked about. It wasn't a popular topic.
Not at all.
But hey, I have 3 kids. Despicable Me is very popular in the house, and I usually use the term. Don't mean to pat myself on the back. But
Matt was right.
It is something we were talking about.
No, I love that. What I think would be interesting to look at, I haven't looked at this in a while, is the fear-greed kind of index.
Oh, yeah. I remember I had that on the podcast. It was right around the market
months ago,
low.
yeah.
It was on the March 30th, right around there, and it got down to like 10 to 15. And the index level, for a reminder, 1's very optimistic and bullish, and 0 obviously is the opposite. And anytime it gets in that kind of mid to low teens, we talked about in the podcast, you're
Extreme
in a vicinity
fear. Yeah.
of usually a short-term market bottom.
Yep, absolutely. All right, I got one more for you.
I'm ready.
Another X post. This is by Bespoke, and this is from yesterday as well. The S&P has gained more than 8% since the last FOMC meeting on 3/18. That's the biggest inter-meeting gain since November to December of 2023, and the 8th strongest on record since 1994.
The 8th strongest since 94.
Yeah, so 22 years, or 32 years, excuse me. So it's just interesting that it's interesting
find that's
how
a
much the
very
market
interesting.
focuses on what the Fed says, is what that,
Very interesting.
comes to my mind.
So a reminder for newer listeners, the Fed meets every 6 weeks. Okay.
Yes.
It doesn't mean that they can't come out in between those meetings and adjust monetary policy one way or another. It's just the pre-planned meetings where they make an announcement is every 6 weeks.
Do you think the market and Wall Street was worried that the Fed was going to hike rates potentially because of the oil prices?
There were definitely some clickbait and
chances.
fearmongers throwing that idea out there. Absolutely there was.
Yeah, it's interesting. I'm just curious, your perspective on why you think it would move this much. I think it's probably a handful of reasons with the kind of oversold market.
Yeah.
is my guess, and looking for a reason to rally back.
Yeah, I just think obviously, we're in an environment where information and computer-driven
Flows so
trading is
fast.
so fast. I'm still in this camp that we are probably going to be in an environment for some time where we overshoot to both the downside and the upside when we have these different moves. And I think the moves are going to be more compressed in time. So a move that would take usually 2 months to play out might happen in 4 to 5 weeks. But then instead of maybe the normal sell-off under those initially challenging headlines of an Iranian conflict might be a sell-off of 8%, it might go to 12 or 13, but the bounce back's going to be so much quicker.
Absolutely.
Yeah.
Awesome. Any last thoughts?
Not necessarily in the market. Earnings season, we still have another couple of weeks on the tail end. This is the bulk this week. That's my comments on that front. Anything before we invite Taylor on?
No, I'm good.
Thanks, Aaron.
Absolutely.
Great content this week, my friend.
Happy to be here as
really,
always.
Really appreciate it. All right, so next up on the podcast is going to be Taylor Ledbetter. Taylor handles all the financial planning work for Jessup Wealth Management clients. She's a CFP, Certified Financial Planner. Taylor, welcome to the podcast.
Yeah, it's good to be back.
How's your week been?
It's been pretty good.
Good.
Yeah.
Happy we're past tax season?
Very happy.
I bet. What do you have for listeners and viewers this week?
Yeah, so today I'm going to be talking about crypto-backed mortgages.
I've heard some headlines about this, but I don't have the details, so I can't wait to hear this.
Yeah, so the reason I wanted to bring this up is because there's been some news that recently came out that Fannie Mae is now backing up crypto-backed mortgages.
Interesting from a collateral standpoint.
Yes. Yep. And for people who aren't familiar with what Fannie Mae does, they basically provide stability and liquidity to the housing market.
Okay.
So when a home buyer goes to a bank and gets a loan, typically that loan is sold to an association like Fannie Mae.
Yes.
So that that bank receives money back and can just lend it to the next home buyer.
Got it.
But the company that is going to be releasing these crypto-backed mortgages, it's called Better Home and Finance.
Okay.
So there are crypto-backed mortgages out there, but this is just the first one that's actually accepted by Fannie Mae.
Very interesting. So they'll underwrite it, and then there's a good chance Fannie Mae could buy it.
Correct.
Okay.
Yes. Yep. So how this product is basically going to work is the home buyer has to have a Coinbase account first.
Okay.
And then a regular mortgage is taken out with Better Home and Finance.
Okay.
And then a second loan is taken out with Better.
Okay.
So that second loan is what is backed by either the Bitcoin or the USD coin.
Okay.
So the second loan essentially funds the down payment on the first loan.
Very interesting.
Mm-hmm. So
Did you think we'd be here 5 years ago? I didn't. I think it would. I would have guessed it would take longer for these things to be adopted. right?
I agree. And I think that we'll probably see even more
I would
of
agree.
this over time.
I would agree.
But I mean, some obvious advantages of this strategy is that the crypto is used as collateral. So instead of maybe having to sell that and incurring taxes, you can avoid that. And you're also able to maintain the future appreciation in the crypto.
Very interesting.
But I think some disadvantages with this strategy is that you are paying interest on 2 loans.
Yes, you are.
So that can get quite expensive.
Yep.
Your crypto is also locked up for a number of years.
So they hold it as collateral.
Right, until the
Yes.
loan's paid off, which if it's a 30-year loan, that's a very long time.
Correct.
And if your crypto does fall below a certain amount, your loan could potentially become under collateralized. So you may have to add more crypto to your account or pay down part of your loan in cash.
Oh boy. Margin call per se, or version of it, right?
Right. And I think from what I read in this article, this strategy has really been implemented for younger generations
I could
who
see
are
that.
maybe struggling to buy a home. And a lot of people do use crypto.
Yes, they do.
So that was kind of the thought process behind going forward with Fannie Mae. But there's also similar things out there too, like security-backed lines of credit if you have individual or TOD accounts.
Yes.
So
Is another way.
right, that's pretty similar. I don't know if I personally love the crypto backed route.
Yep.
I know there are other organizations out there, maybe not associated with Fannie Mae, where you have to use your entire crypto account as collateral.
Interesting.
It sounds like with Better Home and Finance, it's more so going to be just a portion of the account, not the entire one.
I find it interesting. You know, the whole crypto kind of side of the markets obviously are still emerging, and where I just don't think it gets enough attention is just the volatility profile, right? Because it tends to get a ton of headlines when this stuff is moving higher and rallying. But you're not seeing a lot of headlines about the fact, and this is not a recommendation for or against Bitcoin, but it's the largest crypto asset that's in that market. I mean, it corrected from 125,000 a coin or 130,000 to sub 70,000 in a matter of, 4 months, 5 months? And again, it's not to say that that doesn't have legitimacy, but rather, does it fit within someone's risk tolerance and goals and objectives? And that's a completely different story that you're just not hearing a lot of people talk about still. But all of a sudden, when crypto's doing great, everyone's like, oh yeah, I bought it. I bought it when it was under 70. And
Yeah.
it's like, well, in those times, you know, it's not getting very positive publicity. Again, I just want to throw it out there. Does it have credence? It could. But it's just, does it fit your longer term goals and objectives? That's the question.
Right. Yeah. Just kind of what you said, my main concern would be when that does fall, what happens to that mortgage?
That's going to be obviously that impact on that topic, right?
Right. Especially if you're dealing with younger home buyers.
My last comment is I would love just further regulatory guidance on just crypto in general, to give the wealth management world just more predictability on the topic. That's another thing I'd throw out there.
Yeah. Maybe that's to come.
Hopefully, right? Any other final thoughts, Taylor?
No, I don't think so.
All right. Well, thank you everyone for listening to episode 348 of the Independent Advisors Podcast. We'll be back next week with episode 349.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.